So we have the opening bell, first tick here. That is the beginning of the opening range. Opening range goes to 10 o'clock. That's essentially right here. And it started going higher. If you notice, this is your very first fair value gap inside of 9:30 to 10. During the live stream, this is why I have to remind you to go back and look at it. When I toggle between electronic trading hours, is what's being shown here in the lower right-hand corner, I toggle to regular trading hours, which you'll see in a moment. This fair value gap does not appear because you're looking at regular trading hours. The first tick is here. So you're not even going to see any of this here. So because we have a minimum expectation of 931, and then after. We don't want to use any fair value gaps that start with 930 to 931 to 932. Because if you toggle back and forth between regular trading hours by clicking this right-hand corner of your trading view where it says electronic trading, if you change that to session regular trading hours, the very first 930 fair value gap, if there is one, won't exist. So you want to disregard that. So this is the one, and go back and listen to the live stream, okay? Because I actually make a very special notation about that. So this is the one you want to have, and you want to project that out and look at the observation here and here, then rallies at 10 o'clock. So we have the initial opening range of 30 minutes trading from here to here. So what do we have? High, high, low, low. And what I was asking is, I want to see, does price want to go down, upset this first, and then if they would have done that, I would have been looking for it to trade here and treat that as an inversion fair value gap. But because we had both 930 high, relative equal high, this low and this low, both being what? Relatively equal. So what did I teach you going into the 2024 mentorship, Caleb? If we have both and they're obvious, both buy side, clean equal highs, sell side, clean equal lows, wait for the first one to be taken. So which one was taken? The buy side. So this is all fake. This is all a fake run. And how far can it go up? I'm going to sit still, no problem. But then I watched it drop down. If it would have started to accumulate in here, where between this candle's low, this candle's high, midpoint of that is consequent encroachment of this buy side imbalance, sell side inefficiency. If it would have went down, what do I mean by I don't want to see it accumulate? I don't want it to go down here, stop, build a candle, build another candle, build another candle. I don't want to see that. I want to see it do this. Drop down, reverse out of that, and pump up even more. Here's a high. The high goes right to the daily SIBI, sell side imbalance, buy side inefficiency, from July 23rd from the daily chart. Hits it. It sweeps above the new day opening gap. That's what you want to see. It drops back down. Does it accumulate at the midpoint of that buy side imbalance, sell side inefficiency? No, it doesn't. It runs, makes a higher high. What's it trading to? July 22nd, 2024's bearish order block on the daily chart's mean threshold. And what does it leave? Relative equal highs. It drops once more. We don't want to see it accumulate in the midpoint of this buy side imbalance, sell side inefficiency. Does it accumulate? No. Creates a higher low. So we're building what? Sell side. What's below here? Sell side. It has not been traded to yet. So we have the market rally up, and then we create this little gap here. I annotate that, and then we rally above, treat it as support, and now what's it going to reach for? Right in here is buy side. And I don't want to see it trade up to the new day opening gap of August 22nd. I want to see it just bump above that relative equal high. So as it runs up, turtle soup. Breaks back down, crosses over the bearish order block. And I told you, if it's good, it should rally from here and hit that. If it's really, really bullish, it should run up there. Now, to the casual viewer or someone that doesn't really want to learn from me and is looking for some kind of saying, I gotcha. See, you thought he was going to go long here and look, it failed. No, 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 no. Go back and watch the live stream. I don't want to go long in this. Listen. The failure right here, once it did this, I noted that I said in the live stream, I said, did you notice that it failed there? It couldn't reach the new day opening gap. That is indicative of weakness. Once this candle here swept down below that opening price of that candle right here, That's the change in the state of delivery. So every cross above that price action, key point right there, the opening price, that's a short. Anywhere in there is a short. Between that and the mean threshold of the July 22nd, 2024, that is a short. This is the turtle soup. This is the validation of a bearish order block. And anywhere in between that price point and there afterwards is an opportunity to add. Pyramid, build, build, build. And then the market breaks down. It crosses over the August 20th, 2024's new day opening gap. The next candle, rally up. What are we touching? Daily SIBI high from July 23rd, 2024. Bam, hits it, breaks lower. I was talking about this as it's happening. I said, I want to see it trade below this gap here. I want to see it go below it and then come back in, use the lower half of it. Do not trade above the upper half. We want to leave this portion open. The market drops down to the next new day opening gap. And I mentioned it could go back up there, but if it does go up there, it needs to reject it aggressively. It needs to move away sharply, just like that. And it needs to keep the upper half open, unfilled. And that's exactly what we saw on Friday. And the market starts to drop precipitously, aiming for what? Relative equal lows. That's initial or minor sell side. Now, Caleb, you can do that here because this low is lower than that one. So these are relative equal lows. But if you're not going to annotate that, you absolutely have to make reference to these and these because that is your opening range sell side liquidity that has not been tagged or engaged. All of this is Judas swing, all during 10 o'clock when Powell starts speaking. So this is all manual intervention. This is the hand, if you will, knocking out individuals that were already short here. I'm not going long. Go back and watch the live stream. They run it up, no problem. I said, if it keeps going up, it's going to go without me. Listen to what I say in the live stream. There's very little dialogue in Friday's August 23rd's live stream. It's very, very, very focused because behind the scenes I'm trading. And I'm also tired. So it rallies one more time and makes these relative equal highs, comes back down. It does not accumulate inside that buy side imbalance, sell side inefficiency. The fact that it doesn't create multiple candles in the midpoint of here means that it's going to go down and then sharply run higher. So I'm going to expect what? Another drive above this high. And then another drive above this high. Why? Because this did not accumulate down here. So that means this is just running down real quick and they're going to send it one more time as a pump. Don't take my word for it. Go back and look at price action. Or if you've been trading for a long time, you'll see a lot of this happening. And it's going to repeat. It's a signature. Okay. So the market creates this gap here. After running above here, we want to see it pass that over and become a inversion fair value gap. We like the idea of the buy side swept here, so now the market should be in a sell model. Consolidation, rally, all of this is manipulation. Break lower, smart money reversal. Hello. Low risk sell. See the fair value gap, Caleb? You can annotate that. I'm keeping it off the chart, but you do this on yours. And then we break below the old new day opening gap and go below this fair value gap. And we want to see it act as an inversion fair value gap. Watch the live stream. I'm expecting this before it even happens. Comes up, we want to leave the upper half open, hammer it. Breaks. Careens below here, below here, below here, and then what is it working towards? What I opened the live stream up with, mentioning that I like the new day opening gap for August 23rd, 2024, which is Friday's price action. I like that it was inside of the old new week opening gap on August 18th, 2024. That being the high of it and the low of it, and it's sitting right here. That's beautiful. When they nest like that, that is like a huge black hole. It's going to draw price into it. It's so easy to anticipate that that's where it's going to draw to. And what you want to see is them pumping it right at the opening. All of this kind of stuff. It's so easy. It's so easy. You can hear it in my voice. I'm bored. I'm like, I'm not interested in going long. And I tell you that all of this is not real. We're going to be lower later on. And then there you go. I gave you this reaction here before it even formed, like a time traveler, right? So how much further, if we didn't have the new day opening gap down here or the new week opening gap, what else will we be looking for? Well, let's bring in the benefit of having that segment of price action right up there. What do you think that is? That little pink shaded area is my event horizon. Whenever you have a new day opening gap or new week opening gap above and below where you think price is going to draw to, between a new day opening gap like we have here and below that new day opening gap there, if you take your fib and measure that and you put quadrants on it, the upper quadrant, the midpoint, and the lower quadrant, that right there is my event horizon. Notice how it's nesting beautifully where you create the relative equal highs, and then one more time it pumps it above it. Does the body stay inside of the event horizon? Yes. It doesn't even go above the upper quadrant. So midpoint between new day opening gaps and new week opening gaps, the algorithm will reprice to. Like a black hole, it'll draw price into it. There generally won't be very obvious things, but obviously as an inner circle trader, I'm ICT, so I'm going to show you things that the average bear ain't going to see. I'm going to show you what retail can't see, okay? And I'm taking you into where you're not seeing stuff in the candlestick. It's outside the spectrum of a candlestick. It's in price action, yes, but you're not looking at it in a way where the candlestick's going to make very obvious, oh, pay attention here. So these are basically dark pools, okay, or gray pools is what I like to use a reference to. There's other gray pools, there's other PDA rates I have that are very similar to this. Not all of them will I teach, okay, but I might share one more during this mentorship, but no promises. But Event Horizon is something I share with my private students, and it is a midpoint between a new week opening gap and a new day opening gap, or a new week opening gap and a new week opening gap, either or. It could be one of the boundaries above or below. They don't need to be new week opening gap compared to a new week opening gap, find the middle point. It can be either new day opening gap or new week opening gap, okay? So there's no preference, there's no special significance or strength added to it. If it's new week opening gap to new week opening gap, that's not what we're doing here. It's any one of them, but wherever they're in close proximity to one another, using the IPDA data ranges, what is that? It can't be older than 60 days. So your look back with your new week opening gaps, you can't use one that's older than 60 days look back. Why? Because that's 3 months. Once you go past 3 months, the algorithm can use all of them, but I'm using that range of look back as a maximum of 60 days. So for those that want to know how many days can I keep a new week opening gap on, if you want to hold on to them longer than 5 weeks, just remind yourself that if it's older than 60 days, I'm not generally looking at all that with too much interest, okay, especially if I'm going to be using Event Horizon PD array. So that is your Event Horizon. Look how beautiful that is. And there's the inversion fair value gap. And I outlined that real time before it even happens, before it even becomes an inversion fair value gap. I already had it over here. Go watch the live stream. I know it's like magic, isn't it? So if we watch how it dives below the sell side liquidity, the question is how far can it go below that, even if we didn't have the new day opening gap or the new week opening gap here, which I gave to you at the beginning of the live stream on Friday, August 23rd, 2024. So we were there. This is regular trading hours. So Caleb, you absolutely want to be toggling this and capturing the price action and annotating your chart showing this. So we have this gap between the high here, or not the high, but the opening tick of this down close candle. So that's the first ticker at 9:30 it starts trading. And where we stop trading, regular trading session hours, at 4:15 p.m. Eastern Standard Time. That's what this is indicating. So this is your opening range gap, and midpoint is consequent encroachment. I taught you in this mentorship this year that 70% of the time, the midpoint or consequent encroachment of that gap that forms between the difference of previous 4:14 p.m. Eastern Standard Time or regular trading hours close and where we open at 9:30 the next trading day, that is the opening range. If it opens higher, that is a opening range gap that is a premium. In other words, we opened up in a premium. If it opens lower than where we settled the previous day, that is a discount opening range gap. Okay, so it's a lower gap opening. You want to measure that as soon as you get the first tick, highlight that, and then drop your quadrants on it. The main thing is you want to get that midpoint because you're anticipating that. So that's what I was watching for. I was erring on the side of I want to see it drop down below here because it would be that run to consequent encroachment of the opening range gap. But I'm not interested in taking anything here unless it gets to our premium levels up here. The market drops down here to that point. So this is the undelivered portion of the opening range gap. So in other words, from the previous day's settlement price at 4:14 p.m. Eastern Standard Time to the low of that candle right there, this is the portion that is undelivered yet. It is not completely closed in the gap yet. So we want to have this information and project it forward. So we're going to do that now and move the chart over. So this is what it looks like, getting more data. And you can see we drop down into it later on during the lunch hour. So that undelivered portion gets delivered here. Look at the bodies respecting the new week opening gap of August 18th, 2024. Isn't that beautiful? We get this little errant price action here, but the bodies are telling you the narrative. It's telling you the storyline behind it. This is algorithmic. The market runs above. After it does this, this candle goes above. This candle's open. So that's the change in the state of delivery on that candle right there. We trade back down, rally, smooth highs, inefficiency, trade above it, and starts moving back into a premium level and buy side here. I want you to think about what I taught you so far, and I mentioned this in Twitter Spaces in 2023. So when I used to be on Twitter, I'm not on Twitter anymore, but I used to do audio commentary, and I would talk about things that I wanted to talk about, topical studies, or just a rant on Saturdays. I used to call them Saturday Shotgun, or Shotgun Saturdays rather. And it was basically my way of just encouraging people, cheerleading, ranting, and also hiding levels and things that are in my repertoire as a trader, and how to internalize price action with them. And I dropped obviously the new day opening gap, the new week opening gap first, like that. And I mentioned event horizon in passing there, and I talked about inversion fair value gaps. So while every fair value gap should not be looked upon as a potential inversion fair value gap, because it's a fair value gap now, doesn't mean it's going to be used as one. But first presentation is a school of thought that I've taught, and it's not in your books, it's not in all that kind of stuff. It will be now. Everybody's going to put it in their Amazon book. They're racing to write a book based on the 2024 mentorship content. So you'll be seeing people having ICT mentorship 2024 study notes or something to that effect. And you'll finally see the first presentation theory, which is the fair value gap here that forms minimum 931. So you can't use 930's candle when factoring the imbalance candle. The imbalance candle cannot form before 931. So 931, why is that? Because if you toggle electronic trading hours to regular trading hours, your 930 candle won't be there. So it has to be framed on the regular trading session that's occurring right now. So it has to agree in both electronic trading hours and regular trading hours, or it's not a real fair value gap. So if it's going to be first presentation, the candle that creates the imbalance is 931. Very earliest one, it can be that, not before, okay? So I mentioned this also in the live stream. So go back and listen to it, because it's mentioned. I even show you why it's like that. So this is your real first fair value gap for the folks that left comments in my YouTube channel talking about why didn't I talk about this one or refer to that one. Shouldn't that be the very first fair value gap? Go back and listen, and I show you why. And I just amplified it here on Caleb's channel. So this is your very first fair value gap. It's first presentation between 9:30 and 10 a.m. Filter is you cannot have it until 9:31. So that is the earliest it can form it. But once you have one, you take that information and you can project it forward. So we can take that information out here right away. You can see during the lunch hour, we worked below it. I was working with Caleb side by side. I told him, I said, it's going to hit this and sell short, and it's going to attack that low and fill in that undelivered portion of the opening range gap. And look at the delivery there. That, my friends, is perfect. So these are types of events that you want to have in your journal. And Caleb, you want to be looking for these types of things. How is that first presented fair value gap between 9:30, well, technically 9:31 to 10 a.m. Eastern time? How does it behave? How is it used later on? Look how it's respecting it here. You think that's random? It goes up, hits it, drops back down, rolls through it, overlaps it here, and then right there at noon, going into the lunch hours, it's going to sell off. Now, obviously, when I say that, people that don't watch my live streams have never seen me outline 1-minute candlesticks and give you the entire narrative of the day, where it's going to draw to, create the high of the day and the low of the day. That's what was being shown here, and that's where it was being drawn to, and you knew that at the beginning of the live stream. These levels were here at the beginning of the live stream, and I said, I like this, how it's like that's nested down there. So it's a real good indication it's probably going to draw down into that. And man, did it. Here, then retrace all the way back up into the NDOG gap on August 21st, 2024, then sold off, and then working in that first presentation of fair value gap between 9:31 and 10 o'clock Eastern time, New York time, always New York time, sells off, consolidates, bumps the relative equal highs, then sells off aggressively. The bodies tell you we're done. Start to pull back. We're in your launch macro. It starts to come back against the resting buy orders that would have been trailed for anyone that's short. So that right there is just a perfect display of what price action did on Friday. Where we thought it was going to go, it delivered perfectly. Over 200 plus handles of price run that was outlined in advance that went against all of the messiness during a Powell speech. Okay. Manual intervention is most likely going to occur when a Fed chairman is speaking, and usually whatever they give you initially, it's wrong. It's fake. It is not jade. It's a mess, and you're going to get hurt chasing after that. Okay. So if we carry that first fair value gap throughout the entirety of the day, I also taught you in a 2024 mentorship that there is a final hour between 3 o'clock and 4 o'clock Eastern time, New York local time, 3:15 to 3:45. That is a macro. Okay. And look what happens here. The market stops right at the bottom of the first presented fair value gap. So first presentation, 9:31 on Friday, August 23rd, 2024. I gave you the logic. I told you what to look for. I mentioned this in a Twitter space in 2023. And then I've taught you that it was going to be visible to see this in your charts while teaching the 2024 mentorship here. And you want to carry that fair value gap throughout the entirety of the day. Until when? 3:45. Go back and listen to what I said. And look what it does here. It's almost like this price action is running on an AI, like an algorithm. But that's far-fetched, right? So the market goes down and creates the very low at 3:45 at the bottom of the very first fair value gap that I told you. Good old ICT, Caleb's daddy. I told you that that's what is going to be useful carrying it that far, and it hits it perfectly right then and there. Now tell me, that's buying and selling pressure? Is that what you're telling me? That's not what that is, folks. That is absolutely coded logic based on time and price. When they both agree, you got magic. And where does it trade to? Right back up to a previous new day opening gap and swipes above the short-term high there for a buy side. And then it just meanders around into the close.